Hello and welcome to Understanding Credit and Debt. In this module, you will learn how to describe business credit, business debt, identify the 5 C's and what business lenders are looking for, describe ways to be backable and bankable, and how to obtain your DUNS number for your business. The word credit in business refers to either money or product or loan capacity. Credit may also refer to adding money to a person's bank account. For an example, we credited your account for $100. If you have a positive balance in your bank account, it is a credit. The origin of the word credit means to believe, to give credence. Hence, it is the trust in which a lender to provide funds to a borrower who arrange to pay back at a later date. The term may include provisions of money, a loan, or goods or services, as in a consumer debt. It encompasses any arrangement where people pay later. The opposite of credit is debt or debit. So the party lending the money or service is known as the creditor, while the borrower is known as the debtor. Having access to business credit is a lifeline for a business. It enables you to obtain capital when you need to expand, cover day-to-day expenses, purchase inventory, hire additional staff, and allow you to conserve the money on hand to cover your costs of doing business. Today, debts most likely exist in the form of loans and include checking account overdrafts and credit card payments. Good and bad debt. Investors and financiers pay a lot of attention to debt companies have. A firm that has many debts might struggle to pay its interest payments if sales decline. In fact, debt is a common reason why companies go bankrupt. On the other hand, companies with no debt at all could be missing out on major expansion opportunity. Bad debt are those in which a creditor will not pay back their money. The word debt in a business refers to the amount of money that a business owes to a person, bank, or company. Debtors are people who owe debts. They owe money to creditors. Debtors and creditors may also be companies or even government entities. Now, moving on to the 6 steps for managing your debt. Number 1, make a debt inventory. Make a list of all the money you owe and to whom you owe. Be thorough and sincere to yourself when doing this. Any form of debt that was used to sustain the business should be placed on the list. Use a spreadsheet or a blank sheet of paper to record all of that and determine which debt to prioritize. Cut expenses, cut costs. Any unnecessary expenses must go. Understanding downsizing, cut costs on office expenses and other things that are not benefiting or giving you a return on your investment. Split costs with other companies. So find other companies that you may be able to share expenses with. Boost sales. Consider increasing the price of your products or services. Engage with your customers on social media or other media outlets and reward your loyal customers. Refinance all high-cost debt. Pay attention to rising interest rates, since any hike will significantly impact your finances. Negotiate with your creditors if you can change your loans from a variable interest rate to a fixed rate. Assess and rework your budget. Frequently look at your budget to ensure that you are not operating in excess. Find out if you have all your bases covered and rework your budget to cover anything. Shorten your customers' payment terms. For both long and short-term payments, revise payment terms to ensure that the payments are paid on time. You can offer to give your clients early payment discounts or charge penalties for late payments. Learn how to deal with your creditors. Be open with your current situation and apply for a loan before you might need that money. Apply for that line of credit. Ask for a hardship plan if necessary. It is important to have a relationship with your local bank. So when it's time for you to borrow money from your bank, they not only know about you, but they know about your business. The lender looks at an applicant that has thoroughly addressed what is commonly known as the 5 C's of credit. We'll take a deep dive on each one of these C's. So first, character. Character is the factor that relies on who the small business owner is, what his or her reputation is in the community, whether he or she is known to the lender, how he or she will handle previous personal or business loans, and whether he or she's taxes obligations are met on time. And what other factors are known about the individual's integrity? Anyone intending to apply for a small business loan should know their credit score. A lender's scores may vary from applicants' personal credit history. Many lenders use internal detective credit score modules and also methods to determine a loan. A personal credit score may be one aspect of the total score. The Federal Trade Commission provides information about how an individual can get a free copy of his or her credit score. So what is this FICO score all about? FICO is one of the credit scoring systems most commonly relied on by lenders. FICO scores generally range between 300 and 850. The higher the score, the better. The small loans, generally below 350,000, some lenders make credit determinations solely based on an applicant's credit score. Character helps to determine the willingness to repay the loan. Character helps to determine the willingness to repay the loan on time based on your character. A FICO score is also calculated based on good and bad information in your credit report as well. There are some common errors on credit reports that you may want to pay attention to, so it's always great to check your credit at least once a year. Common errors found on credit reports is information that is not yours because a confused name or an address. Also, problems about identity theft, information from an ex-spouse, outdated information, incorrect payment status, more than one delinquent date on an account, wrong notation for closed accounts, and delinquencies not reported correctly. Now, moving on to the second C, capacity, cash flow. The amount of money that you make or expect to make, cash flow, should be significant to pay for all expenses allowed, a little extra in case something unexpected comes up, of course. Capacity is a measure of whether a business can afford the loan. That is, will there be enough or adequate amount of cash to pay all of your business expenses, including the new loan payment on time or in full? If you are an existing business, lenders will look at how much money you have made in the past based on historical data as shown in your business financial statements or tax returns, usually the last 2 years plus current year to date. If you're just starting off in your business, a lender will rely on your business plan, your estimate projected cash flow you will make, also your revenue, and how much money you would need for all your expenses. The third C, collateral, guarantees. A collateral is something of value that you own or will buy with money from the loan that you will pledge to secure. Most lenders also require business owners' personal guarantees the loan as well, a promise to repay the loan even if the business fails to do so. The fourth C, capital contribution, shows your commitment to your business and what you have to risk if your business fails. A lender expects you to be committed and also contribute something towards your business, equity injection. In other words, have some skin in the game. Be prepared at least 10 to 30%. Especially with traditional lenders, lack of equity usually means loans will be turned down. Condition. A business must be prepared to determine what there's a market for their business or a clear purpose for the loan. The guarantees can be based on the local or regional national economy, the competitiveness of your business, the type of industry, and your experience in the field that you are managing. Now, since we've covered the 5 C's, let's talk about how do you get your DUNS number? A DUNS number is a very important number to have. It's a unique 9-character number. A DUNS number was created by credit bureaus. DUNS numbers have become the standard numbering system to identify businesses across the globe. Applying for DUNS number is a simple process, but it does require you to first establish your business as a legal entity, either as an LLC, a C Corp, or S Corp, etc., with your state. Now, since you know a little bit about credit and debt, follow the next 2 steps to complete the next exercise. Go back and listen to the 6 steps of how to manage your debt and create a plan for yourself. Second, apply for your DUNS number and see where it takes your business. It will take it to the next level.